Hey there, Wealth Press subscribers and viewers. Welcome to another Monday Weekly Roundtable. This week we've got Roger Scott, Lance Ippolito, and Jeff Zandaneri all here to pipe in on what's happening in the marketplace. I'm going to start with you today, Lance, because we saw China, the Chinese government actually came out and gave a bit of a boost to the Chinese stock market and suggested that investors should be piling in. And what effect has that had from where you sit?
Correct. I believe the brokerage firms were up about 10%, if I recall. Looking over at the markets last night, and we are seeing it's shocking the inflow of call buying into these China ADR stocks, and it's all short-term massive call buying. So we're seeing TME, Tencent Music Group, VIPS Holdings, Huya, another one that's about a $21 stock, and then of course you have your BABA, your Asher, the ETF as well. They are a QD, a China Internet Software name. They are just call flow. They actually started buying calls last week, and we're seeing traders now that a lot of these stocks are up around 10%, taking profits on the in the money calls now, and then rolling those profits to further out the money calls. So they're still buying, and they still want exposure to these names. Again, though, I want to put the focus on this is all short-term call buying. They're not going out to September or December. We're talking about weekly options if the underlying has them, or we're talking about July, which is the July 17th expiration, I believe. So very short-term, but aggressive call buying.
You bet. So, Jeff, do you think that might have something to do with what happened the last time the Chinese government gave a boost to all of its stocks?
I'll tell you what. I mean, if we think we have a bubble here, you haven't seen the Chinese retail trader will leverage his own balance sheet 10 times. So typical Chinese per capita GDP is about $15,000 a year. To put that in perspective, typical Americans about triple that, like 46 grand. And you'll see these guys, when they get that green light from the Communist Party, they will go at least 15K, at least their entire year's salary into the stock market. And so the way that they fiddle with it, the government, is they control the amount of leverage that they can use, the Chinese retail traders. And they really manipulate it up and down. And so in a way, I think I've never seen them so, they have FOMO. It's almost like Xi is sitting there and he's like, wow, Trump is manufacturing this NASDAQ rally and we're lagging. It's like an arms race in stock bubbles happening. So this one's a little bit scarier because I haven't seen them so committed to creating a bubble. Last time they did it almost accidentally, and then they raised the capital requirement. And if you look back at 2015 Shanghai, it went straight up and then it came straight down almost immediately. I'm not sure this time. It's a little trickier because it seems like, as I said, it seems like an arms race between these guys. And I don't think they're gonna want to have that international egg on their face if this bubble collapses just as quick as it expands.
Sure. It's interesting, if you compare what the U.S. is doing by front-loading the banking sector with $2.3 trillion in Tier 1 capital that can then be exponentially banked out 8 to 10 times. That's one way to juice the trading segment. Right. And then the Chinese sector is more like, well, we're going to tell you it's time to start buying. And then we're also going to make your capital, your leverage ability maximized so that under no uncertain terms will you be confused about what our intent is here.
I mean, it would be the American equivalent of the Republican Party coming out and saying it is your patriotic duty to buy these stocks right here and right now. Not only is it your duty, but you need to borrow as much money as we'll allow you to. And by the way, it's the most ever to buy stocks. That's what's happening there.
Right. And we'll lend you the money.
Yeah.
Low interest.
Well, so Roger, what effect has that had on U.S. manufacturing?
Well, that's a very good question. First of all, I just wanted to add just one more layer on top of this China talk. Remember, we still have the trade war. in light of everything that Jeff said and in light of everything that Lance said, add that on top of it, which complicates things further. And knowing how, I don't want to get big on propaganda and how much of what Chinese does is propaganda, but I think a lot of this has to do with posturing. I think a lot of this has to do with posturing, which is in effect what Jeff was talking about. And it's very, very hard to understand the logic behind this, especially in light of their underlying conditions right now. So I honestly don't know what to make of it. But I will say this. We are starting to see now. Chinese are saying that there's a pickup in manufacturing in China, and I don't know if that's true, but we are seeing a massive pickup in manufacturing stocks rising here in the U.S. And if that is happening in China, that could be one of the reasons for it. I mean, fundamentally, that's happening in China, not on a technical basis. But I'm not sure that's the case. I'm still very hesitant to see that. But I got to say, I would have expected, in light of everything we're seeing with the COVID-19, with the trade war, I would have expected healthcare stocks to still stay up. But I'm looking at my cumulative strength index, and even healthcare stocks are lagging behind manufacturing. So I'm scratching my head and thinking to myself, if U.S. manufacturing is on such an uptick, maybe there is something going on in China that we're just not, we don't know. That's just one perspective. But at the same time, I have to say, and with everything I know, with everything that's on the table, with all the numbers coming out, I just don't see how that could be the case. So I am in full agreement with Jeff and Lance. I just wanted to throw this manufacturing out there because we're seeing such a massive pickup in US. I don't know if you guys saw this morning, the manufacturing index just went crazy, and it's been on a tear last few weeks. And I looked at my cumulative strength index, which takes the 6 month, 3 months, and 1 month and averages them out. And for the second time today, manufacturing's behind consumer discretionary and tech. It's the only positive thing besides those two out of the 10 sectors. So it's
huge number. Yeah, I don't mean to interrupt, but
no.
You're saying it was a huge number. They were expecting 50%. Anything above 50 on the ISM, for those of you guys that don't know out there, it denotes expansion in the economy. And it came in at 57. So it was like we were talking about last week, how off these guys can be. The employment number, they were off again. Sorry, Roger, I didn't mean to interrupt you, but just please, to magnify how big a manufacturing number came out, like you're spot on.
Yeah, and I just want to add, please, this is a discussion. The whole point is I want to hear you guys' thoughts of what, it gets very lonely up here. This is a very lonely profession, as you guys know. This is the only chance I get to talk to other people. So this is great. But I wanted to just add one more thing. In addition to the manufacturing really going crazy, there's a few manufacturing stocks that I've been looking at before today even. For example, General Holdings, GNRC, we're talking up 70% year to date. This other stock, Yeti, which does outdoor and recreational markets, it's up like crazy. So we're seeing the ticker symbol, by the way, General Holdings is GNRC and Yeti, it's YETI. Just take a look at those stocks, and those are basic manufacturing stocks, and they're just killing it right now. I mean, really, they're on a tear right now. And I'm seeing some others as well. Even Applied Materials, which is technically a manufacturing, but semiconductor, even that one's on a tear. So there's something going on here because honestly, manufacturing, we can argue, I think we're all going to agree on this part, and I want to hear what you guys think. But if you take tech, that's kind of obvious. Consumer discretionary, yeah, that's kind of obvious. It goes hand in hand with tech. But materials has been really lagging behind for a while now. So if materials can get things going, that's really a major catalyst. So do you guys think this is for real, or do you guys think it's just another aberration, one of which we've been seeing in the market for quite a bit? What do you guys think on that?
I've been looking at money flow, right? And really in XLB, the material ETF, I like following it. Follow it every day as one of my sector ETFs. And I'm looking at it right now. Let me pull up the top holdings in it. Where are we? XLB. There we go. The only thing I've really seen that I kind of like is Double D. And of course, you have Dow Chemical in there, Newmont Mining. Newmont Mining I like as well. But every time these names get a pop, I mean, you look today, they're already fading near the lows of the day, these material stocks out there. It's hard to get bullish on one sector, so to speak, when you just see continue fading, and still no true inflow, like no sustainable rally. We'll have like a 2 or 3 day pop, so to speak, and then it's rotation right out again. I've been tracking and liking metals and mining, XME. That's something that actually caught my attention over the past few days. You go look at steel stocks, you go look at names like Freeport, some Palladian names. That's seen some flow that I like, and it's not, buying tech at the highs, so to speak. And that's where I do think there's opportunities in trying to find what's the next rotation that can last in the market. Instead of just saying, hey guys, go and buy Tesla and, Google and Netflix and, pray the market goes up.
Jeff, can I ask you, do you see this sort of rise in interest in materials as potentially the harbinger of a shift into commodities away from stocks, in line with the expectation that the debasement of the currency is starting to have more of an influence on the major capital pools of the world?
I'm cynical on the brick and mortar, like traditional the traditional economic growth model. I think is busted.
Yeah,
I don't think it's close to coming back. I think if you're gonna play the long side in the reemergence story, you got to do it, as Lance has been really like very on point in pointing out that it should be a trade with a specific type of time horizon. But to jump all in on this long-term recovery on the economy and buy these things because they're so quote unquote cheap is how you really get taken out. Because I think that we're so far below what we're used to seeing in the global economy. And we've had such a huge run in some stocks because of liquidity. And people have lost sight of the fact that, like, I'll give you an example. Las Vegas Sands is a casino company. It's not a manufacturing company, but I'm just talking about economic activity and how far down they've fallen. Las Vegas Sands in June saw 97% lower revenues than the year before. 97%. The stock's not down 97%. It shouldn't be either, because this is something that's going to, obviously, we're going to get through. But to give you an idea of how effed up things are in terms of people doing stuff, that's one thing. So we've lost sight of it because you're seeing all these great tech stocks, and it was like, okay, these tech stocks are going crazy, but like, I have a lot of people, I have a lot of amateur, type of traders, friends and stuff that are like, I want to short Tesla. And I've had friends that have wanted to short Tesla since they found out about Tesla. And I'm like, there's two things you can do with Tesla. Nothing, which is usually the case that I prefer, or you can play it small long. But to be short Tesla is like ultra suicidal, like almost like Vietnamese, what is that game? Russian roulette with the gun. Like the scene, like that scene Deer Hunter, where they're just like, I'm going to be the one guy that made money short Tesla. And it's like, okay, yeah, the stock's expensive. It doesn't make sense. You think it's a fraud. I get it. But to get in front of those kind of momentum trains it's just not what you do. It's not what you do, in my opinion. And it's easier a little bit in reverse on the valuation side to get in front of like, to bottom pick stocks that have fallen a lot, where you could see a recovery where the intrinsic value of the company is there, and you don't even need full recovery for them to be cheap. For instance, 2008, the banks were so cheap, trading at like 30% of their book value, that you knew just like a slight return to normalcy would see 3x the banks. So you picked up a Bank of America at $3 when their book value is $10. Those types of trades, deep value. I don't think we're there yet. To answer your question on the materials, or like a lot of things in terms of valuation.
And I just want to be very, very clear. the even the basic material stocks that I would want to look at would be stocks that are really outperforming the market and have an angle that has something to do with the new economy, either staying at home or alternative power or things like that. So I think we have to really be careful right now. But I agree with what Jeff and Lance is saying. This is a very, very cautious market, and we have to be very, very careful. We have to be very, very careful in how we approach this. And again, the stocks that I'm looking at are stocks that are being taken advantage of right now for the current time. Like, for example, one of them deals with generators. The other one deals with outdoor activities. The point is, these are things that are happening right now. But yes, overall, I couldn't agree more. We are very, very. It's a very fragmented stage in the cycle, and we have to be very, very cautious. So even when you're looking at all of this, you got to look at all of this with a grain of salt. Volatility levels are out of whack. Energy prices are just now coming back. There's a lot of things that are still out of whack. So it's going to take a while for things to come back. And that's why I'm only looking at things or at stocks that were doing well before this happened and are now doing even better as a result of what's going on right now. There's an increased demand. In other words, I'm not looking at stocks that may do well in the future. I'm looking at stocks that are already doing better because of what's going on. And I think we have to take that approach. I think we have to look at positions. We have to look at stocks, and we have to look at trends that are doing well now and we're doing better before. We don't want to look for changes right now. This is not a time to look for trends. This is a time to take advantage of sure things.
Sure. Do you guys think, I want to just go back to that statement about the coronavirus related stocks there, Roger. It's funny that you mentioned GNRC. I bought a Generac pump for my irrigation system just a couple of weeks ago. So I was thinking, why does that name look so familiar? Oh yes, it's on the name of the pump that I actually used yesterday to move some water around. So that makes sense. And I'm looking at actually my portfolio of coronavirus directly related stocks to the virus itself, to cures, treatments, and vaccines. And they've all done very well. Quidel Corp, the company that was the first to be officially licensed to sell home tests for coronavirus, is at $250. When we first talked about it, was at $150. Wow. Novavax, which we first discussed at like $6, is now at $78 a share, an unmitigated home run for anybody who got to play that. And even some of the other ones, Cytidine, we called it at $249, and it's now up, traded over $8, now down to $6.50 as a result of a bit of a short attack. But that's to be expected when a stock on the OTC rises by 6,000% in a week. So all these stocks are really performing well. So going back to your statement about trends, it would strike me that is generally true. But in the case of the coronavirus stuff, given the amplified rate of infection globally, which now stands at about 1 million new cases a week, right, that we can expect increased interest in this sector, not necessarily representative of a trend per se, but certainly representative of a headline catalyst that is driving extraordinary interest into that sector. So would you concur with the idea that, you might still want to be buying some of these coronavirus stocks, or at least adding to positions as they continue to be the beneficiaries of this headline-driven interest?
Absolutely. I think it's a very, very smart idea, because until we have a cure, until we have a vaccine, volatility, the markets will not be the same. Society will not function the same way until either we have mass exposure, till this is not a question anymore, and that's going to take a long, long time, or we have some kind of a cure. Till that time, there's going to be a heightened sensitivity, a heightened delta to anything to do with COVID-19 or related to COVID-19, or in any way helps the way economy is moving, helps the direction in which people are moving to, whether it's safety, preservation, But any benefit that we derive from a company that has to do with COVID-19, in other words, if COVID-19 was not here, this would not help us. That's the question. And if the answer is yes, bingo, that's the stock. I think there's going to be heightened market capitalization, heightened sensitivity, heightened volatility till someone comes out like Pfizer says, hey, we have a vaccine. We've got a vaccine. It's off the table. Then things will start deflating. Things will have there's going to be a massive reorganization of assets and how we view economy. But till that time, I think we're going to be in the specific mode where anything related to COVID-19 is going to kind of like if you had a company that was related to the internet back in the late 90s, it would rise, that's how you have to look at COVID-19 right now. It's the internet of the 90s. All right. Anything that had anything to do with if you had the word internet in your description, the stock would go up 10 times. That's how I'm looking at COVID-19. Whether it's ultimately going to be extremely helpful or not, anything related to COVID-19 is going to get extra love from Wall Street right now.
Mm-hmm. All right. And so with that, Roger, you were kind enough to give us 2 picks this morning. Jeff, how about a couple of picks from you? What are you trading today?
Wow, way to put me on the spot, James. Happy Monday to you. I'm not going to give you picks, but I'm going to give you some levels to pay attention to. I'm watching the dollar very carefully, and I know a lot of people, especially that view your stuff, are really interested in commodities and interested in gold. And if you don't have a view on the dollar, then you shouldn't really be trading those things, because as we know, they're all priced in dollars. So I'm looking at a breakout on the upside of all things for the dollar. And it's been one of these things that's been stuck in a range for some time, and it's getting a little bit of selling here in the beginning with the bullishness. But if the dollar can break out above 97.20 on the dollar index, I think that commodities need to look out for a little while on the downside. But just the case that I'm, looking at personally.
All right. And Lance, anything in particular that you think we should be following?
But going back to Jeff, the euro, nice little rally on the euro today. And I think, what are we at, about a monthly high on the euro? For the coronavirus play, a name that doesn't get mentioned a lot, APT. They make the mask. And as we have more states going to mask or mandatory, keep an eye out for that one. One name that I'm continuing to look at is TME, Tencent Music Group. It is, we were talking about China names to begin. I'm still seeing huge inflows to it. It's, Spotify has, over the past month, a phenomenal breakout to the upside. They signed Joe Rogan. Then Kim Kardashian got a show there, and the shares just exploded. It's funny. Wall Street always gives these China ADRs like a comparison. Like Lumpkin Coffee was the Starbucks of China. We all saw how that ended. But Tencent Music Group, they call the Spotify of China. And it is, to be fair, only a $15 stock. But when I see, inflows into a stock that's a relatively new IPO, and traders are right before on a position taking profits and then buying more at a further strike, so rolling profits out. To me, that's really bullish. If the trader was right once, chances are they'll be right again. So I like that name, and I'll continue to stay bullish on it as we did for the members of Sweet Spot Stocks to start off July.
Fantastic. All right, gentlemen. Well, that's a great update. We've run pretty much the full 30 minutes as usual, and I really appreciate all of your input. Have a fantastic trading week, and we'll talk to you later in the week. Thanks for joining us today.